So here's another article in the New York Times. It says clamping down on rapid trades in the stock market. This is a little older. This is from late last year. It says regulators in the U.S. and overseas are cracking down on computerized high-speed trading, worrying that as it spreads around the globe, it is making market swings worse. One idea that the regulators had was to ask these high-frequency traders for some of their algorithms. So they said, hey, we want to take a look at what you're actually doing and how you're going about your trades and so forth. And the industry basically replied that, first of all, we don't want to give you the records, of course, because it's proprietary information. Second of all, they put it very poetically. They said, we have reservations about the ability of the SEC to gauge the effectiveness of such algorithms. Basically what they're saying is, we don't want to give you the information, A. Second of all, we strongly believe you're too dumb to understand it anyway, which is kind of insulting, but that's the perception, that Main Street isn't going to be able to understand what Wall Street does, so let's just move on from there, right? It's beautiful. So, give a little more background on here on this high-frequency trading. This is a study from Yale that I found was quite interesting. It says, institutional turnover was remarkably stable, around 20% per quarter throughout the 1985 to 2009 sample period. It's increased from 40% to over 60% in 2009. Institutional trading volume has basically tripled within that short amount of time. It says from 1985 to 1994, stock turnover was also very stable, around 17% per quarter, a number close to the average institutional turnover over the same period. However, quarterly stock turnover has increased dramatically after 1995, climbing to 100% by 2009. So what this turnover refers to is how many times basically a portfolio is replaced within a year. So 100% turnover would say a whole entire portfolio is replaced within a time period. So that's what turnover is referring to. So basically what they're saying is people are changing their securities a lot more frequently, and this may be due to the high-frequency trading environment that we're in. Now, all this goes back to the fact that I tell people all the time, this is a different market than we've been in. You know, you cannot react to CNBC and think that you're going to have an advantage in the market. It's not that simple. By the time you see something on CNBC, it's such old news that nobody's even paying attention to it anymore. So that's one aspect. That's one thing I always try to tell clients, is that you need to look at the market in a different way. It's definitely not the same situation that we've been in even 10 years ago. So if that was not scary enough, I wanted to point out a great example of what can happen when you have automation and insufficient oversight. So let's take a look at this book here. Now, anybody on the call can take a look at this book. It's called The Making of a Fly. And I just want to ask what you guys would pay for this book. I'm sure everybody's asking, why does Alex have fly on his presentation? Well, there's a very good reason. Let me give a little bit of background. What the seller of this book did was they decided to have a program adjust the price of this book automatically. And the benchmark that the seller used was the price of a different book. So let's say this Making of a Fly is book A. It pegged its price to the price of book B. But what happened was, coincidentally, that the seller of book B pegged the price of that book to this one. So they were rigged against each other. And the end result was that this Making of a Fly, the price was $23.7 million plus shipping. Now, how did this happen? Well, it says the market blind book listing was not the result of uncontrollable demand for Peter Lawrence's classic work in developmental biology. Instead, it appears it was sparked by a robot price war. Now, this is great. This happened from April 8th to April 18th in 2011. It says one equation kept setting the price of the first book at 1.27 times the price of the second book. And the other equation automatically set the price of the other book to 0.99% of this Making of the Fly. So the prices of two books escalated in tandem into the millions, with the second book always selling for slightly less than the first. Not that it matters when you're selling a book about flies for millions of dollars. The real price for this book, of course, was about $100, and it goes to show you a little bit of insight into what can happen when you have computers trading against each other, which is exactly what we have in the market these days. High-frequency trading does not involve people for the most part, except to program them, turn them on, and set them off on their way. So I think this is a good parallel, a good example of what can happen if we keep letting this high-speed trading dominate the market, and an example of what can happen if we let it get out of control. So that's a quick word on this $23 million book. I'm sure it's a good book, but I'm saying I wouldn't pay anything over $15 million for it.